Global markets have pretty much picked up in 2025 where they left off from the end of 2024 and even going back 2 years. Equity markets have strong year to date. Interest rates and bond prices have sort of chopped around a bit, but largely unchanged. But it really has been the equity market that's been continuing to move higher. A number of sort of regional or country share market indices are at record, or have set new record highs or fresh record highs, continuing that strong trend from late 2022. And what we're seeing is, and pleasingly what we're seeing is a broadening of the equity market strength. And what we mean is, as opposed to some of the last couple of years where the infamous Magnificent Seven, those mega cap technology companies, mostly based in the US, were doing a lot of the heavy lifting. What we have seen year to date is that a broadening of that equity market strength. So the likes of the European share market, the UK, Hong Kong, and some of the emerging markets, they've delivered strong returns, outpacing the US equity market for once. And we can see the same thing at a sector level. Communication services are still doing very well, but the likes of some of the more cyclical sectors, the likes of financials, materials, industrials, also delivering strong returns. And usually that broadening of an equity market strength is a positive for the sustainability of that rally. In 2025, when we think about the economic data that's been coming out, it's really been a continuation of the themes coming through from the end of 2024. Looking at economic growth, interest rates and levels of inflation, we're seeing economic growth still holding up better than many had feared and better than expected in most regions and countries around the world. Inflation rates have come down from those peaks we saw a couple of years ago following the COVID crisis. Still not quite back where central banks would like to see them, but in many places more in the middle of the band. And interest rates also continuing to normalise back from restrictive settings to more moving towards neutral. There is still a bit of dispersion around the world. The US continues to be the standout. 2024 economic growth of 2.5% was slightly less than 2023, but still nothing like the sort of shallow recession that was predicted or feared for following those high interest rates through 2022. The central bank there has stopped cutting rates for now, having lowered them in 2024, and with such a strong sort of economy there, they're going to be a bit more patient. Inflation there is still in the high 2s, 3% was the last print, so the central bank there would like to see that back more towards 2 before cutting interest rates further. And with that strong economy, they've got the benefit of they can be a bit more patient. If we think about the likes of Europe, the UK, Australia and New Zealand probably in this basket as well, economic growth a lot more tepid, not sort of recessionary or terrible, but just subpar, unsatisfactory, lumpy, and interest rates continue to be lowered there. And we've seen interest rate cuts from, again, New Zealand, Australia, the UK, the European central banks. And there, in those places, the good news is that the inflation headache is mostly in the background. The inflation levels have come down in those areas where the economic growth is softer. So that is mostly a positive development, and we still haven't seen the feared recessions that were predicted a year ago. Geopolitics have continued to be a source of volatility for the markets year to date. The two main ones would be the onset of the tariff, escalation in tariff or potential tariffs. With the US White House changing hands, that was expected that President Trump would use some of those old tools from his previous spell in the White House and using tariff, the threats of or the implementation of as a bargaining tool. So that was of no great surprise. The surprise has probably come more from the on-again, off-again nature of the announcements. We've had tariffs announced and then reversed or delayed, and that has made planning for any company or any industry very difficult, especially multinational companies, and that ongoing uncertainty around tariffs has driven some of the volatility in markets. And the other one would be the potential for some resolution of the terrible conflicts in the Ukraine and in Gaza, where while there's still a long way to go, the hope that there will be some peace settlements there has been a positive for markets. The likes of Europe have had to put up with a cost of living crisis like many parts in the world, but a lot of that was driven by high energy prices, and already we've seen natural gas prices in Europe come down sharply as on the potential for some peace talks to yield a better future there. We're still constructive on the outlook for global equity markets, and we don't believe now is the time to start to get defensive with our positioning. Company earnings, as we saw in the most recent earnings season, have, a bit like economic growth, continued to surpass expectations, continued to hold up well. So as long as we see companies in aggregate continue to grow their earnings, that's a solid base for equity markets. And we also have the benefit of those lower interest rates in just about every part of the world starting to flow through into the broader economy. Lower interest rates or higher interest rates usually take 12 to 18 months to flow through to consumers, to businesses, to governments, and we are less than a year from the point where most central banks around the world started easing rates, so we're still really yet to benefit or see the benefits of those lower interest rate settings. So with a combination of solid fundamentals for companies and for equity markets, and still that fear of the recession, the investor sentiment we think is still pretty mild, pretty muted, not euphoric, so that makes us sort of constructive for equity markets in 2025.